Joining me now is Potomac Wealth Advisors founder and president, Mark Avallone. Mark, great to see you. Thanks very much for being here. What are you expecting from this data, and how do you want to allocate capital through the rest of the year?
Well, I think we're in a slow period for the market. Certainly the August-October period is one of the slower periods. And in this year, it's not going to be much of an exception because the data is very murky. There's a real cross current right now. There's a lack of clarity. There's a lack of a catalyst to push stocks higher in the near term. There's concerns still, legacy concerns about how high inflation remains. Sure, it's down off the highs, but it's still well above the Fed's 2% target. So with all these cross currents and interest rates at relatively elevated levels, it doesn't seem to be an optimistic time for investor. Typically 4% or more on the 10-year has been a soft ceiling for stocks. And with inflation not fully behind us, we don't expect rates to come down, and we don't expect the Fed to loosen, as a lot of people are talking about and hoping for. We don't expect that till mid-2024.
Yeah, I was surprised that we haven't seen more of a negative reaction from these markets as people start digesting the idea that the Fed is not going to cut rates anytime soon. We're waiting to see how weak this economy gets after 11 rate hikes already. We'll get the second read of second quarter GDP out tomorrow morning. And economists are still expecting growth of 2.4% in the last quarter. The August PCE report's out on Thursday, Mark. Your thoughts on what you're expecting from this data?
Well, look at the conundrum the Fed has put themselves in. We now have a slowing economy, and we have relatively high interest rates. So typically when the economy slows, the Fed would be able to ease or at least pause. But we have wage pressure. We have very aggressive unions being very successful for their members. No one's against people earning more money. But from a policy standpoint, these 10% annual raises at UPS, American Airlines, United, they only get the thirst up from the United Auto Workers unions, who want then other unions to then negotiate aggressive wage packages. And it doesn't seem that the impact of wage price hikes is being realized throughout the inflation expectations, and the cost of labor is almost always a negative for stock prices. So the Fed's in a tough spot with a slowing economy, cost push inflation, and inside a slowing economy. And that's where I think the cross current is.
Great analysis. Mark, it's good to see you. Thanks very much.
Good to be here.